Having a core satellite investment strategy offers many advantages to investors. One of the most notable advantages is its ability to minimize tax liabilities. Because the core of the portfolio consists of passively managed investments such as index funds, which generally have a low turnover in the portfolio due to their buy and hold nature, realized capital gains taxes are minimal when compared to an actively managed portfolio. With that said, the actively managed portion of the portfolio is still very likely to generate tax liabilities due to realized capital gains taxes. Because of this, a core satellite investment strategy is ideal for somebody who's looking to minimize their tax liabilities while still offering some potential to outperform the overall markets.
To volatility as a core satellite portfolio, there are a few things that you should consider. So the core component of that portfolio is really focused on stabilizing the returns as it's fully diversified and tracking broad market trends, whereas the satellite component of the portfolio is really focused on beating the market returns. And if you couple those together, you have the core, which are your long-term stabilizing investments, coupled together with the satellite investments that are shorter, more specialized holdings that do take some active management. You have the potential to really put together a winning formula. So if the specialized satellite holdings perform very well, you have the opportunity to really enhance the return, the potential return. Whereas if the satellite components underperform, you still have the core that stabilizes those returns.
For those of you who are looking for a cost-effective way to construct your portfolio, the core satellite investment strategy may be for you. This strategy seeks to minimize costs through the combination of passive investing and active investing. Passive investments are almost always less expensive than their active counterparts. Since passive investments track the indices, the portfolio changes only when an index changes. Due to the fact that indices change pretty infrequently, transactional costs and capital gains taxes are all minimized. In addition to the passive investing, active investing is layered in when deemed necessary and efficient.
For the satellite portion of the portfolio, it can be considered the portfolio's fund money, and this is where investors can take some of the money and put it into sectors that they feel will outperform the markets in the short term, or areas that they just want to take a chance on. But for the actively managed portion, the goal is to select investments where a portfolio manager's skills will provide opportunities to outperform the market and earn greater returns than those in the passive portion. For example, with the 25% that you've set aside for the satellite portion, you could invest into high-yield bond funds, a biotechnology fund, and commodity funds. But the bottom line, a core satellite approach is a great way to focus on long-term capital growth while still allowing the opportunity to juice returns through active portfolio management.
In the core satellite method, we utilize two types of trading styles, both passive and active management. The core portion of the strategy follows a passive strategy. This portion consists of investments that are pretty much meant to track the index. You follow a buy and hold strategy that is meant to minimize costs, tax liability, and volatility. The satellite portion, on the other hand, is actively managed. You decide how to invest the money in order to beat the market, and you take advantage of short-term market fluctuations. You are actively trading in the style and adjusting your position in order to optimize your returns. Unlike the passive style of investing, this approach will tend to be more expensive and most likely will come with a higher level of risk, but in turn have higher returns.
So I'm going to talk about the implementation and how to effectively design a series of core satellite portfolios. The following factors that I'm going to list are what you need to take into consideration when designing these portfolios. The first consideration is you need to determine the risk profiles and strategic asset allocation. The second factor is determining the investments for the core. Third is determining the size of the core versus the satellite in each asset allocation, or each asset class. And the fourth consideration is to determine how many active satellites are to be used and which ones to complement the core portion of the portfolio.
Hello, I'm going to go over my 4 considerations for the core satellite strategy. First strategy is, does it meet the financial goal of the client? Does it fit for them? 2, overall allocation. Want to know what other asset classes they own elsewhere to make sure we're not over allocated. 3, your time. Core satellite strategy can get a little time intensive, especially on the actively managed side, so make sure you understand that. And then 3, taxes. With actively managed portfolios, taxes can kind of get up there, and so those are the 4 things that I consider with the core satellite strategy.
Another very important consideration about the core satellite investment strategy is all the different advantages and drawbacks that this investment strategy has. Some of the advantages of the core satellite investment strategy are that first, it really allows you to customize your portfolio through the use of the satellite investments, all without the significant risk or overall performance of the overall portfolio, because the majority of the investable assets are held within that core account. Additionally, this strategy allows you to partake in both passive and active management, again without the significant risk to overall portfolio performance. And lastly, this is a great strategy if you're trying to increase the diversification within your portfolio. Some of the drawbacks to the core satellite investment strategy are going to be that while it can offer outperformance through the use of the satellite investments, the satellite investments also run the risk of underperformance or significantly worse performance, performing worse than your core investment strategy, thus reducing your overall portfolio's return. And additionally, depending on your advisor's fee structure, this strategy could significantly increase the different transaction costs because of the use of these satellite investments.